Good day, everyone, and welcome to our webinar for February 2025, the first one of this year. I hope that you had a good festive season and you've returned refreshed. Obviously, it's a long period, 2 months, so there's quite a lot to talk about. And we will begin, as usual, in America. If you look on your screen, you should see the S&P 500 showing basically what has happened since the election in November last year. You can see we've gone through various different patterns here. What has happened, of course, is that as we get to the top of this great bull market, or as we approach the top of the bull market, it becomes more sensitive to the news flow, and this tends to make it more volatile. And that can be seen in overreactions to various items of news which come out. Most recently, the news that the Chinese AI chip maker DeepSeek would compete with NVIDIA. That news broke about a week ago, just over a week ago, and it caused a pretty sharp movement. NVIDIA shares offloaded hugely, the whole market came down, and I said at the time in a tweet that it was probably an overreaction. You should basically be following my tweets if you want to get my up-to-the-minute thoughts about what is happening, especially on the S&P 500. The second piece of news that rocked the markets in the last week or so was the announcement of Trump's new tariffs on Canada, Mexico, and China. But of course, that also resulted in an overreaction in the marketplace. And what you have to get hold of and keep hold of is that the underlying bull trend is basically being fueled by the strength of the US economy. And that has not really been disturbed significantly by any of these events. And you can see that in the jobs number, which came out for December last year. The American economy created 256,000 new jobs in a single month. That's way more than the 155,000 that economists were generally predicting. And at the same time, the unemployment rate fell back to 4.1% from November's 4.2%. That level is hovering around what economists call the full employment rate. They believe that if the unemployment rate falls below that, then obviously there will be a shortage of workers in the economy, and that will tend to push wages and salaries up, leading to higher inflation. The strong December jobs report number means, of course, that rate cuts are likely to come less quickly in 2025 than was expected. Of course, the Fed did cut rates by 0.25% in December, but at that meeting they said that there probably will only be another 2 25 basis point cuts in 2025, and that is down from what the market was expecting, which is four cuts in 2025. And so the market was disappointed, and of course that caused the share prices to fall. On the 18th of January, when that was announced, the S&P 500 fell almost 3%, 2.95. Tesla shares fell 8.3% in a single day, and Paycom fell 10.1% in a day. We always said that that was an overreaction, and we have remained consistently bullish, predicting new highs on the S&P 500. So you must distinguish between the ripples on the surface, which are difficult to predict, and the direction of the underlying current, which is clear. Of course, the Fed does not want the unemployment rate to rise. It's comfortable with levels just over 4%, but it does want to bring core inflation down to 2%, and inflation is becoming quite sticky at these levels. Trump's inauguration and his taking of the office of the presidency does not really change the inflation prospects. He has little or no control over monetary policy in America. But that did not stop him, of course, from saying that the Monetary Policy Committee was wrong not to reduce rates. He went ahead and said that anyway. The Monetary Policy Committee is a highly competent, very well experienced and qualified group of men and women who assess the US economy and make decisions about interest rates based on their mandate, which is to keep inflation under control while at the same time encouraging growth. Trump knows little or nothing about what they do, in my opinion. Anyway, core inflation did rise in December, but much less than expected, coming in at 0.2% for the month. For the previous 3 months, it had gone up by 0.3% in each month. So this figure boosted the S&P 500, which rose 1.5%. Now, fourth quarter earnings reports are coming out for the S&P 500 companies. They began on a very positive note. 80% of earnings and revenue were above estimates. The best performers were in the financial sector, and earnings were generally about 9.1% above estimates, with 67% of the companies reporting beating their revenue forecasts. Later, of course, we had Meta, Tesla, and Microsoft coming out with their results, which were pretty much in line with expectations. And most recently, we had Apple, which reported better than expected results. So generally, the quarterly results are pretty good. At the same time, we got the GDP growth figure for the fourth quarter of last year, which was a solid 2.3%, slightly below predictions of 2.5%, but still a very good number. GDP growth for the whole of 2024 was 2.8%, which is just slightly below 2023's 2.9%, and that shows that the economy is still growing steadily. It shows that the Fed has been successful in achieving a soft landing, despite the sharp rise in interest rates. In the last 4 months, of course, of 2024, the Fed cut interest rates by a total of 1%, or 100 basis points. Now they want to step back and watch the effect of this. We regard this as a healthy approach. It is slowing the bull market down without endangering it. We expect the upward trend to continue to new record highs in due course. But of course, there will always be corrections. Of course, in the period that we're looking at here, there are 3 public holidays. You may have noticed that. There was Thanksgiving over here in November last year. Then, of course, the public holiday associated with Jimmy Carter's death in January. And then, obviously, on the 20th of January, the Martin Luther King Day. And on those days, the market is closed. On the 2nd of January, over here, we tweeted that the market was returning to risk on, and it would begin a new upward trend. So that was in our tweets. If you're not getting our tweets, I strongly suggest that you have a look at them, because they do give you information between my articles and between the confidential reports. So we believed at that time, on the 2nd of January, that we'd now enter a new upward trend. As you can see, it's starting to shape up here, although it is subject to quite a lot of volatility. The rand would also strengthen. Both of these predictions have come true despite some shocks to the market. The S&P 500 made, of course, a new record all-time high at 6118 on the 23rd of January. And we expect more record highs and, of course, more corrections. On Friday, the Trump administration announced the tariffs against Canada, Mexico, and China. There's not a lot of detail on how this would work. The stated objective was to stop the flow of fentanyl into the US. It is possible that these tariffs could result in a correction on the S&P 500, but at the moment I feel that that's quite unlikely. Trump is also, of course, threatening tariffs on the BRICS countries, of which South Africa is a member, We don't know how that will impact our economy, but the governor of the Reserve Bank here, Letsetja Kanyago, warns that tariffs could negatively impact on economic growth. Trump has also, of course, taken America out of the Paris Accord on climate change. Given the extraordinary wildfires in California recently, this seems a little foolish. The melting of the permafrost could spike methane into the atmosphere, and that would push the world through some major tipping points on climate change. It's well to remember that America uses about 20% of the world's oil, burns about 20% of the world's oil, but only has about 4% of the world's population. So they really should be at the forefront of fighting climate change. All right, let's turn our attention now to Ukraine. Both Russia and Ukraine are desperately trying to gain territory before the peace negotiations, which are anticipated sometime in the next month or so. Russia has been making small gains in the Donetsk area, while Ukraine has been pushing forward in the Kursk area. Both sides are stretched very thinly, and both sides really badly need a ceasefire. Ukraine has also been attacking Russian oil infrastructure in the last month or so with devastating effect. This is now starting to threaten Russia's oil export revenue, which is obviously used to fund the war. It's becoming apparent that Ukraine is slowly winning the drone war. New technical innovations have enabled them to strike more or less anywhere in Russia with drones that they manufacture in Ukraine. Russia is talking about wanting the war to continue, but it really cannot afford it. Trump, in our view, could exert considerable pressure on Putin to negotiate. The troops from North Korea are now out of the fight. Quite a lot of them were killed. But North Korea, of course, is still supplying Russia with ammunition, which is keeping them in the fight. Trump is, of course, a wild card, and it's very difficult to predict exactly what he will do. His pronouncements and actions since the inauguration are generally radical, and markets have been more volatile as a result. In our view, one way or another, this war will end sometime this year. NATO, of course, has the resources to continue with the war and to continue supporting Ukraine, while Russia does not. Okay, let's look at the political election situation in South Africa. The political situation, by-elections in Limpopo and Natal saw the Government of National Unity gaining ground in both areas. Zuma's MK party is battling to make headway, especially in the Limpopo area. This is good news for investors because it makes Zuma's return to power less likely. Recently, Ramaphosa has ruled that spaza shops must register with the government. This follows the deaths of 20 children from food processing. The government has now distributed 13,600 forms, which their spaza shops are supposed to fill in. Less than 2,000 have been filled in and returned. This, of course, is an effort to formalize and legalize the informal sector, and in our opinion, it will definitely fail. The informal sector operates outside the law, but employs millions of people. And this is true for spaza shops, it's true for the taxis on our roads, and it's of course true for informal settlements. The rules of the road are flaunted every day, as are the building codes in the squatter camps. This results in deaths, road accidents, flooding and fire victims in the squatter camps and so on, and now of course poisoning from the spaza shops. The only solution really is better law enforcement, but at this stage that seems quite unlikely. The Government of National Unity is of course mainly an alliance between the DA and the ANC, and it is threatened by the National Health Insurance scheme of the ANC, and of course more recently the expropriation of land without compensation, and of course the Basic Education Law Amendment, Bella as they call it. None of these areas of conflict between the DA and the ANC has yet caused a break in the GNU, but of course they all do represent a danger. They will require some delicate maneuvering and negotiating. All right, looking at the economy, the Monetary Policy Committee cut inflation, the interest rate as inflation receded. Prime overdraft rate is now at 11%. This, of course, reduces the pressure on bondholders further, and it follows the US decision to leave rates unchanged in America. But it is a catch-up because you may remember a while back the Americans cut by 0.5% and we cut only by 1/4, so it's a bit of a catch-up. Interest rates are falling throughout the world, but the pace of decline has slowed. Germany is in a technical recession while the UK and France are slowing. China is also underperforming from an economic perspective. Trump's tariffs threaten a trade war, which would obviously be bad for growth everywhere in the world. But I am in doubt as to whether those tariffs will actually be applied, and certainly not in the form which Trump first spoke about them. The Reserve Bank, South Africa's Reserve Bank, is expecting growth of 2% only by 2027. We are somewhat more optimistic about growth here in this country. The Institute of International Finance says that South African economy will grow by 1.9% in 2025, and that, of course, compares with the IMF's prediction of a 1.5% growth. And the world economy is expected, however, to grow at 3.3%, so South Africa is still way behind the rest of the world. The end of load shedding is a major factor in growth, but the recent return to stage 3 is a little bit of a scare, and it shows the vulnerability of the system to more load shedding. We believe that growth will surprise to the upside in 2025, provided there are no more serious shocks to the system. GDP shrank by 0.3% in the third quarter of 2024, mostly because of agriculture. Agriculture is a major factor in GDP. Excluding agricultural growth, it would have come in at positive 0.9%, so it's not too bad. The drought is beginning to impact the maize crop. Agricultural spend was down by 29%. The effects of El Nino are still being felt, and also we've had an outbreak of more animal diseases, so that's been a problem. Inflation in South Africa dropped to 3% in December, mostly because of lower fuel prices, and this was just slightly above November's figure of 2.9%, but still very well under control. We are now at the bottom of the Reserve Bank's target range of 3 to 6%, and so we're looking at inflation which is very strongly under control. In 2025, inflation is expected to be 4% for the whole year. Egg prices, food prices have come down significantly. Egg prices are down 3.7%, while bread and cereals are both cheaper. The South African Chamber of Business Business Confidence Index reached a 9-year high in November, showing that businesses are very optimistic about load shedding and about the GNU. Falling interest rates are also now a growing factor. This should translate into more investment and more spending. Rail and port logistics remain a major problem. Retail sales in the year to the end of November were up 7%, which follows on from October's 6.2% increase, which is very good. General dealers were up 12%, and household furniture sales were up 9.4%. This shows that consumers are spending. Finance applications were up 3% over 2023, but the arrears on bond repayments reached almost 7%, showing that some bondholders are really taking strain. Some of the new spending is coming from the two-pot retirement system, which was recently introduced. Falling interest rates have not really brought a great deal of relief yet to people in substantial debt. Okay, the Standard & Poor's Purchasing Managers Index came in at 49.9 in December, which is down from November's 50.9, shows that the economy slowed a little bit. Construction particularly was slower. The job numbers were unchanged, but input costs did increase. New car sales in 2024 fell by 3% from 2023. Vehicle importers gained some market share at the expense of local manufacturers. Total vehicle sales were up 2.5% in December over 2023, but commercial vehicle sales were down 12%, mainly due to lower sales of taxis. Manufacturing production was up towards the end of last year. Rubber and plastics rose 4.5%, while food and beverages were up 2.9%. The sector is, of course, benefiting from 10 months without load shedding. The prospect of lower interest rates is also helping. Mining production fell by 0.9% in November, pulled down by gold, iron and coal. Platinum group metals were up 4% and chrome was up 15.6%. South Africa, of course, remains an exporter of raw materials, despite the work on beneficiation. We are always a price taker rather than a price maker. Black Friday sales were pretty good at record levels. According to Capitec, it processed 25.4 billion rands worth of transactions over that weekend. About 2 billion was spent in supermarkets in 52,000 orders. The Bureau of Economic Research reported business confidence at a 3-year high in the fourth quarter of last year. Bank of America says that the ratings agencies could push South Africa up 2 levels, which of course will not yet take us to investment grade, but is a great improvement. This is because of increased GDP, which is expected by most economists because of the GNU, and also hopefully debt levels can be controlled or reduced. Obviously, better ratings from the International Ratings Agency will result in lower interest rates, and it is possible that eventually South Africa could return to an investment grade rating. Water is rapidly becoming a problem, especially in Gauteng. Only about 54% of our water is now drinkable, and that's down from 95% in 2014. About 40% of the water that we get is lost to leaks and theft. Water outages are on the rise. The water infrastructure is old and dilapidated. Sibanye and other mines are having stoppages due to lack of water. The municipal water is unreliable and increasingly expensive. At the same time, Eskom is teetering on the edge of bankruptcy, sustained only by government grants. The massive debt is owed to Eskom by the municipalities has now reached 110 billion rand. The debt program is not working because municipalities are not complying with it. Eskom is putting up prices again this year by 12.74%, and that has been approved by NERSA. Since 2015, electricity prices have risen by an average of 15% per annum. Thousands of users are leaving Eskom and to make their own plans with renewable energy. Eskom is slowly dying and is being kept alive by constant government bailouts. The city of Tshwane, for example, owes Eskom 6.7 billion rand. An agreement has been reached to repay this, and that agreement has been made a court order. Repayments will take place over 4 years. That could be a model for other municipalities which also owe Eskom a lot of money. Impala has signed a deal which takes its reliance on renewables to 90%. This will effectively take it away from Eskom as a customer. So 90% of its electricity will come from renewables. The deal also reduces its carbon emissions by 850,000 tons over 5 years. So this is a very significant deal, and I'm sure most of the mining companies in South Africa are doing a similar thing. Okay, Transnet. The Business Day published an incredible picture of the 7-kilometer queue of trucks waiting to deliver coal to Richards Bay. This is a symptom of Transnet's huge logistics problem. The port bottleneck is costing South Africa a fortune every day. Some mines have been forced to reduce production as a result. Transnet itself made a loss of 2.2 billion rand in the 6 months to the 30th of September 2024. The 6 export corridors which it manages are plagued by theft and vandalism. It says it needs 14 billion rand a year to repair the 21,300 kilometers of railways which it's responsible for. Transnet's debt also is ballooning. It's now reached 151 billion rand. So this is becoming a problem for the Treasury, as happened with Eskom. The rating agency Standard & Poor's has put Transnet on watch. It says that sooner or later it will need a government bailout. The Minister of Finance, of course, Enoch Godongwana, says that the government will not give any more bailouts to state-owned enterprises. So there's no allowance for such a bailout in the latest budget. We, on the other hand, agree with Standard & Poor's that at some point the government is going to have to take responsibility for Transnet's debt, and it will have to get involved. Michelle Phillips, who's the Transnet CEO, is planning for private-public partnerships. She's got a whole lot of plans like that. The new projects could begin as early as May 2025. For example, a manganese export terminal at Ngqura, costing about 20 billion rand. An upgrade to the Durban-Johannesburg corridor, the Pretoria Eastern Cape corridor, which is used for motor vehicles, also needs an upgrade, and an upgrade to the Richards Bay coal terminal, the RBCT. These contracts may offer a near-term funding solution for Transnet. Okay, let's look at the rand. Just get the chart on the screen here. Okay, yeah, that's the one that I want there. So that's 2 years of the rand. And what is most noticeable is that since the US elections, which are over here on the chart in November, you can see that the rand has basically been weakening against the US dollar. And that is really because of the uncertainty surrounding what Trump is going to do about South Africa. He makes all sorts of pronouncements on his social media channels, but we have to find out exactly what's happening here. He's spoken about imposing 100% tariffs on BRICS countries. Against this, the Government of National Unity obviously is positive and is attracting new investment. But the rand, which reached a cyclical low here in September last year, has been weakening steadily since then. That cycle low was at 17.11, and the rand is now well over 18 rand. So we'll just have to see what happens. Of course, if we have continuous rand weakness, that becomes inflationary after a while. Some JSE businesses may have to get into new markets which are not American, non-US markets if there are tariffs. Despite this, we believe that the rand is going to get stronger in the longer term. Another important indicator is the oil price. I'm just going to go to the Brent chart here. As you can see, oil has been in this descending triangle with support at $72 and this falling upper trend line where we had a cycle high on the 5th of April at 91.50 and then another cycle high this year on the 15th of January at 82.31. This spike in oil from there to there was caused by the Middle East crisis. Once that was resolved, the oil price has started to trend down, and we expect that that will continue. Okay, so the trend in oil is reasonably good. All right, so a falling oil price, of course, is very bad for Putin, and the Trump administration may decide to work with Saudi Arabia to bring oil prices much lower, down to, say, $45 a barrel. That would be intolerable for Putin and the Russian economy. Okay, now I'd like to just take a moment to talk about Krugerrands. Okay, this chart here shows the Krugerrand over the last 40 years. I bought my first Krugerrand back in February of 1985, somewhere around there, and I paid 600 Rand for it. Today, that same coin is worth 50,000 Rand. So it's held its value very, very well indeed. And in fact, it's even grown in value, in my opinion. Gold is the ultimate asset. It's the most secure asset you can have in your portfolio. And because it's the most secure asset, it has the lowest return. In fact, it generates a zero return. What you've got to look at here, though, in this chart, is that this period of 40 years includes the 87 crash, 1987, which you see over here, the dot-com crash of 1998, the 9/11 attack on the World Trade Center in America, the 2008 subprime crisis, and more recently COVID-19, and yet still the Krugerrand keeps on going up. It's something which has lasted through the corruption and mismanagement of the Zuma era, and gold coins have just held on to their value and continued to grow. Gold, and of course Krugerrands especially, are a hedge against the weakness of paper assets. Currencies, equities, bonds, and all other assets are represented by paper. Gold is the most secure of all investments, and so it has a zero return. It does not pay any dividends, rent, or interest, and it does not add 10% to its weight every year. But it is a very secure place to keep your money. If you take 1 ounce of gold 5,000 years ago in Egypt, that would have bought you the same number of chickens that it would buy you today. And after the World War III, if that ever happens, it will probably still buy you the same number of chickens, albeit probably mutated. Its purchasing power never really changes. That's the point I'm trying to make. Its only problem as an investment is that it pays no return. Krugerrands are by far the best and most widely recognized of gold coins in the world. More Krugers have been produced than all the other gold coins in the world combined. So the American Eagle, the Canadian Maple Leaf, etc., etc. Most countries have a gold coin which they mint. But the Kruger was the first of these gold coins, and it started being produced in 1968, and we've produced thousands and thousands of them, and they are recognized throughout the world. You can take your Krugerrands to Tokyo, to New York, anywhere in the world you go, and you will get the same value for them that you would get for them in Johannesburg. They are made from a thing called royal gold, which is of course a composite. It's an alloy. I think it's got about 9% of nickel or something, and it's very, very hard and durable. It's also very portable. And Krugerrands have got the great advantage that your name does not appear on them. So you can do what I do. You can put a couple of Krugerrands into the change pocket in your wallet and take them to any country in the world. And there you will get 50,000 Rand per Krugerrand. In a country like South Africa, where we have a high degree of political risk, our advice to investors is generally to have roughly 10% of their wealth in Krugerrands. Kept somewhere safe. You can keep them in a safe deposit box at your local bank, and they will just keep on going up, as they have done for the last 40 years. All right, let's look at some companies. I'd like to begin with Richemont. Richemont is, of course, South Africa, one of South Africa's iconic international companies. It supplies and sells luxury goods around the world, China, America, Europe, and so on. It is the ultimate Rand hedge share. In its latest quarterly results, it shows sales up 10% to 6.3 billion euros. It's an enormous amount of money. The shares have been trending up for some time, and we added them to the winning shares list, as you can see here, on the 9th of January this year at 2,924 Rand a share. There you can see the impact of these third quarter results that I'm talking about, and this is where the share is now. So we added them to the winning shares list on the 9th at that price there of 292,438. They've gone up very significantly, and they're now trading for 362,500. So that's a very nice 24% gain in less than a month. We expect the share to continue to perform well. Hudeco, this is a company which imports and sells industrial, consumer and automotive products in South Africa. It has a diverse range of businesses. I just want to put more data on the screen. We first drew your attention to Hudeco in 2021, on February 2021, as an interesting share to have in your portfolio. At that time, it was trading for just over 100 Rand a share. Later on, a year later, in February of 2022, we published another article about it. By that time, it was trading for 157 Rand. And then we added it to the winning shares list on the 20th of June 2024, and then it was trading for 175 Rand, and it is closed at 202 Rand last night. So it's been going up steadily. And this company has developed a skill at making what are called bolt-on acquisitions. So a bolt-on acquisition is an acquisition which is small enough to be not to require shareholder approval, and which can generally be funded from the company's existing cash reserves, and it doesn't really threaten the company. Even if it's a mistake to make the acquisition, it's really too small in the context of the overall group to be a major problem. So Hudeco makes these bolt-on acquisitions all the time. A while back, they bought Kodak, for example, the company that produces gas and gas fittings and gas cylinders. I'm sure you know about Kodak. Their latest acquisition is a company called Isotech, which they bought for 709 million Rand. It's a provider of insulation materials, and it fits in very well with some of Hudeco's existing businesses, most importantly Power, Might and Verispeed. It has an after-tax profit of 90 million Rand in its most recent year. So they bought it at 709 million. If you divide the 709 million by the 90 million profit they make, Hudeco has paid a price earnings of 7.9 times earnings. So Hudeco's shares currently trade in the market for a PE of 10.6. So that 90 million will immediately be re-rated from a PE of 7.9 to a PE of 10.06. This means that Hudeco shareholders make an immediate gain. All right, so you can see the general pattern here. This is a great investment, and it has been a great investment for many years. It's exactly the kind of thing that we encourage our private investors to get involved in. The company pays regular dividends. It's extremely well run and managed. It's got a strong balance sheet, and it continues to make these bolt-on acquisitions, so growing the business into new markets and enabling it to do cross-selling to the new acquisitions client base. All right, finally I want to talk about Hyprop. Hyprop, as you know, is a real estate investment trust, very well known because it owns quite a few of the top shopping malls around South Africa. For example, the Rosebank Mall, Canal Walk, Hyde Park Corner, Clearwater Mall, and so on. In a trading update for the 6 months to the 31st of December, turnover was up 4.9%. And it's got its shares are trading in the market for just over 43 Rand. Here they are, 43.48. But it's got a net asset value of 60 Rand and 32 cents. And remember that net asset value is based on properties, valuable properties like the Rosebank Mall. So it's not packed out with intangible assets, as you often find with the net asset value of some companies. We believe that property shares are generally undervalued in South Africa, and they are very secure investments, very solid investments, and they should continue to perform well going forward. At the moment, Hyprop is trading at about 27% discount to its net asset value, so we think it's good value. Okay, folks, well, I hope that you found something of value in that report. Remember that the notes are available to you also on our website. And if you like this video, please click the like and subscribe buttons. We would appreciate that. Otherwise, I'll be talking to you again next month on the first Wednesday in March. So I look forward to that. Thank you for listening to me.